Financial Mappers updated the default rates in April 2020. The examples in this document do not reflect this information. This is the list of the new default rates. If you are using an old plan, you can update your default rates for a specific plan. Click on the icon Plan Default Rates on the Planner page and make the adjustments. Financial Mappers makes it easy for you to create a plan where you can have a predetermined set of goals to match certain statistics, financial targets and asset allocation. Statistics and asset allocation are found on the chevron reports Plan Outcomes. Financial targets have a chevron of their own, Targets. These are the three reports which will give you a quick review of the results. Financial objectives and lifestyle goals, plan statistics and indicators, check your plan outcomes. For demonstration purposes, screenshots will be a 20-year savings plan for a single person. John Citizen is age 40 and has a salary of $150,000, of which he is saving 15% for the next 20 years. He owns his own home debt-free and wants an investment plan for the next 20 years. He currently has $200,000 in the transaction account and has indicated he wants to purchase an investment property in year 1. You may like to start the plan construction by writing the plan objectives and the main strategy. If there is any additional information you want to refer to, this can be entered on the panel General Comments. At the bottom of the page, you can create a list of your milestones. When this information is completed, each panel of information can be included in any of the reports listed here. Note that if the panel is blank, then the report will skip the heading. This information can be found in the report Financial Objectives and Lifestyle Goals. For this plan, the following information has been included on the chevron objectives. The main strategy has been written and some general comments. In addition, milestones have been added. Note that the person is taking a gap year and wants to be debt-free by the end of the plan. Financial targets are set on the chevron Targets. You can have up to 3 sets of targets. The program automatically selects the years based on the length of the plan. Targets will not extend beyond 30 years. There are 3 types of targets you can set. However, any of these can be unchecked. Here's a tip. If you save the panel before entering any information and then click on the button Compare Results, you will see the actual results of the plan. Note that the dollar values are in present value at the end of the year, and the investment return is the real return where you have an inflation rate of 2.5%. We have now added the targets and compared the results. This information is also displayed on the Review chevron. If you do not enter any values for your targets, then the target results only will be displayed. For some, this is all you want to see. If that is the case, you should add the additional 2 targets. In this section, we will have a brief discussion of the plan. Please note that this plan is not a recommended plan, but a demonstration of the software in a time-efficient means. First, we need to enter John's salary. John has indicated he is taking a gap year in year 15. Part of this time will be on long service, so he expects to have a salary of $70,000. Thus the salary has been changed for this year. No adjustment is made to the salary allocation in this plan, as John will still have to service his investment property loan. In the gap year, $40,000 will be transferred from the transaction account to the budget to supplement the income for that year. An emergency cash account is created. In year 1, $50,000 is withdrawn from the transaction account. Interest is reinvested. It was recommended that John purchase an investment property to the value of $500,000 using $100,000 of the funds in the transaction account for the deposit. This will mean that no mortgage insurance will be required and John's home is not required for additional security. The non-cash tax deductions are entered. The recommended loan is a 5-year interest-only loan followed by a 15-year principal and interest loan. This loan was selected so that loan payment cash flows could be exampled. In this example, the plan wanted to start building up funds in a high-growth managed fund. One feature of financial mappers you may like to use is one of our handy quick calcs, the loan comparison. This allows you to compare 4 loans which may be of different interest rates, loan costs, deposits and length of loan. This allows you to decide which is going to be the best loan for you. It was recommended that 2 managed funds be created, a high growth fund and a balanced fund. A percentage of salary allocation after loan cost is to be allocated to the funds. High growth fund 80% for years 1 to 10, and then the balanced fund 70% for years 11 to 14. The reason for switching to a balanced fund in the last half of the savings plan was to increase the percentage of defensive assets. No allocation was made in year 15 because the client is taking a gap year. No allocation was made in the last 5 years as it was felt that the balance of the transaction account needed to be increased. The high growth fund has investment returns as 5% income and 7% capital growth, with dividends being reinvested. The investment return on the balanced fund is 4.5% income and 6.5% capital growth. With the superannuation account, this has been left as a simple employer type fund. At the end of the plan, the value will be just over $900,000 present value. In the investment plan, the program deducts the loan expenses net of rent. These are displayed in red on the graph. Note the smaller deductions for the first 5 years where the loan is interest only. For the first 10 years of the plan, 80% of the balance of the funds are transferred to the high growth fund. In years 11 to 14, 70% of the available funds are allocated to the balanced fund. For the last 6 years, no allocation is made and the funds are deposited into the transaction account. Statistics are found on the Chevron report's plan outcomes. The debt servicing ratio is a very important statistic for you to understand. In the 5-year loan report and the debt management report, 2 ratios are described with and without additional loan payments. The ratio on the plan outcomes page includes additional payments. This may help you ensure that you are not overcommitted to loan payments even with these additional payments, which are optional. Note that the percentage is the percentage of loan payments compared to the after-tax salary. Another interesting statistic is income as a percentage of target income. If you look at the plan details page, at the bottom of the entries you can enter a target retirement income which defaults to $100,000. If you look at the bottom section of the debt servicing ratio graph, you will see a line indicating the percentage of that target retirement income. This can be quite handy to see where you are in terms of meeting your retirement income based on the current returns on investments. This calculation divides the net investment income, excluding loan payments but not loan fees, plus income from retirement accounts by the nominated target income to give you a percentage. The program calculates both the nominal and real returns of all investments and retirement accounts. The real return is the nominal return discounted for an inflation rate of 2.5%. This is the value you should pay most attention to. Sometimes it is called the after-inflation return. Let's now look at investment and risk return profiles. These terms are describing the allocation of defensive and growth assets. The investment profile calculates the percentage of interest-earning assets, that is, cash and fixed interest securities, and allocates according to 5 bands with an additional band for 100% cash or no growth. The allocations are no growth, low growth, conservative, balanced, high growth and aggressive. In this example, the whole plan has an aggressive profile. This may be something you would like to adjust in the plan. On the plan outcomes, the only graph is for the investment profile for investments excluding retirement accounts. However, the data view displays both the investments and retirement accounts together with the combined total. The risk profile displays the percentage of growth assets for each year. This graph is modelled on the ASIC Money Smart graph. The graph divides the risk levels into 4 broad bands: conservative, 0 to 30% growth assets; balanced, 30 to 75% growth assets; high growth, 75 to 85% growth assets; and aggressive, 85 to 100% growth assets. The data view displays all three sets as percentages. The first asset allocation graph displays the allocation of assets into retirement accounts and splits the investments into three broad categories, which are 1. Cash, term deposits and bonds, including those assets held in the managed fund. 2. Equities and other investments such as precious metals or artwork. And finally, property and property trusts. These values are also displayed in the data view. In addition, the assets are divided into 8 categories, which are also available in the retirement accounts. These categories are cash, domestic fixed interest, global fixed interest, domestic equities, global equities, other investments, property trusts, and real property. When you use the data view, the allocations are presented in both dollar value and percentage in either present or future value. The information is presented for investments, retirement accounts, and combined. The report, Plan Statistics and Indicators, explains some of the terms so that you can have a better understanding of your plan and the terms used. The following are screenshots from the report excluding the disclosure statement. After the introduction, the first statistic explained is the return on investments. The asset allocation is displayed as an overview. In addition, the allocation is displayed for each of the 8 asset classes. The 3 graphs display the asset allocation for investments, retirement accounts, and the combined values. The investment profile is displayed only for investments excluding retirement accounts. This gives you a broad overview of the profile, which in this case is displaying aggressive. The percentage of growth assets are displayed for investments, retirement accounts, and combined. The debt servicing ratio is displayed as a graph with more detailed information for each of the first 5 years. The final item is confirming that the modelling tools are off. If you have accidentally left the modelling tools on, then the report will be inaccurate and you should return to the plan and deactivate the modelling tools. On the review page, you can quickly see the results for any year by moving the slider. You can also click on the information icon to see a graph for the full length of the plan. The review chevron also includes 2 extra panels. The second panel will display the 4 key indicator graphs. This is also found at the top of the plan outcomes report. The third panel will display the investment target graphs. Financial Mappers is designed to be educational and fun to use. Sometimes it's not about creating very complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions you make. We like to think you can use Financial Mappers as a doodle pad, where you can look at very simple concepts and then try to understand what is likely to make the best outcome for you.